Section 8, 3 approaches to value. Sales comparison approach, usefulness of the approach. Most reliable approach for appraising single-family homes. Most reliable for vacant lots in established neighborhoods. The rationale of the approach is the principle of substitution. A knowledgeable purchaser will pay no more for a property than the cost of acquiring an equally acceptable substitute property. The underlying assumption is that market price is valid evidence of market value. The challenges associated with appraising real property is the fact that each property is unique. Sometimes you don't have comparable properties that are identical to the property of interest. And real estate is traded infrequently, and that means you must rely on a small sample of traded properties. Comparable properties must involve the transfer of same property rights, the legal estate, as the subject property, same highest and best use. At arm's length transactions, the party deal from equal bartering positions. They act in their own best interest and not subject to each other's control or influence. Elements of comparison. The appraiser adjusts transaction prices of the comparable for the differences from the subject property. Elements of comparison. Transactional characteristics and property characteristics. Transactional characteristics is the conditions of the sale, financing terms, seller's concessions, market conditions, personal property, and location. Examples of sales concessions would be interest rate buydowns, seller paid loan discount points or loan origination fees, seller paid closing costs customarily paid by the borrower, refunds of or credit for borrower's expenses, and non-realty items in the transaction. Referring to market conditions, would a comparable sales price be different in today's market? Adjustment is required if, since the time the comparable was sold, property values in a given market have either appreciated or depreciated. Successful sales analysis would be sample properties that have sold twice over time. Market conditions adjustment formula. Resale price minus initial sale price equals the difference in prices, divided by the initial sales price equals the percentage of change, divided by the number of months between sales equals the monthly rate of exchange. Here is an example of making a market conditions adjustment. A comparable sold 6 months ago for $210,000. During the past 6 months, sale prices have increased 5% in that neighborhood. So what do? Take 210,000 times 5%, you get 10,500. You add that to your 210,000 to give you a total of 220,500. Now the comparable sales price adjusted for market conditions is $220,500. Personal property is any tangible items that's not permanently attached to the real estate. Fixtures are former personal property that's been attached to the real estate. Now it becomes part of the real property. Trade fixtures necessary for business are considered personal property. Location is judged in relation to the comparable properties. Proximity to employment, schools, shopping, and recreation. Compatibility of land use and the quality of homes in the surrounding area. buffer from external diseconomies, and availabilities of utilities and transportation. That is the paired sales analysis. Property characteristics that may require adjustment: age and condition of improvements, the size of the improvements, the number and size of rooms, type and quality of construction, architectural design, amenities, and physical characteristics of the site. Match pairs analysis. Select pairs of cells in the market, one with the item for adjustment and the other without the item. If a single characteristic is the only difference between two cells, the difference in the two prices can be isolated to the characteristic. Adjust the comparable to make it like the subject. If the subject has an item the comp does not, adjust the comp price upward, the value difference. If the comp has an item the subject does not, adjust the comp price downward for the value difference. And you'll remember from your pre-licensing course, CBS and CIA. If the comp is better, you subtract. If the comp is inferior, you add. An example of applying adjustments: a comparable lot sold for $30,000. The comparable is in a better location, but is smaller than the subject. The appraiser estimates the difference in location to be $5,000 and the difference in size to be $4,000. Here is our adjusted price. Sales price minus $5,000 plus $4,000 is $29,000. The sequence of adjustments. First, you have the normal sales price. You're going to adjust the actual transaction sale price for condition of the sales, financing terms, and seller concessions. 2, market conditions adjusted the normal sale price. Adjust the normal sale price for market conditions. And 3rd, the final adjusted sales price, you're going to adjust the market conditions, adjusted normal sales price for location and physical characteristics. Now, you're going to reconcile the adjusted sales prices using the weighted average. You reconcile the comparable's adjusted sales price into one single indicated value. The cost approach theory is that a knowledgeable purchaser will not pay more for a property than the cost of acquiring a similar site and constructing an acceptable structure. The applicability of this approach is for new or proposed construction, little market activity, and unique properties. Steps in the cost appreciation approach. You're going to estimate the cost of improvements. You're going to estimate depreciation and subtract from the cost. You're going to estimate the site value, and you're going to add the site value and site improvement value to the depreciated cost of the improvements. Reproduction cost is an exact duplicate. Replacement cost is the same use and functional utility, but using modern, available, or updated materials. Methods of estimating cost: quantity survey method, unit and price method, and comparative unit square foot method. An example of an estimated reproduction cost new. The main structure has 2,100 square feet. At $85 per square foot, it gives you $178,500. The garage is 440 square feet at $55 per square foot, and that will give you $24,200. The lanai is 200 square feet, $25 per square foot, gives you $5,000. When you add them all up, you have $207,700. Accrued depreciation is the value difference between an existing structure and a new copy. Types of depreciation is physical deterioration, which can be curable or incurable, functional obsolescence, and external obsolescence. The methods to estimate depreciation include the breakdown method, market extraction method, and age-life method. This is the most commonly used method. It estimates a total depreciation and uses ratio between effective age and economic life. The age-life formula. Effective age equals the age indicated by condition and utility. Economic life equals the total time in years that a building is expected to contribute value. And your formula is effective age divided by economic life times reproduction, or you can do reproduction cost divided by economic life times effective age. Here's an example of a lump sum age-life method. A house with an estimated reproduction cost of $207,700 has an effective age of 4 years. The economic life of the house is 60 years. So here's your solution. 4 years divided by 60 years times 207,700. That gives you 13,847 rounded. The alternate solution, which truthfully makes more sense to me, and it's the one I use, 207,700 divided by 60 years times 4 years gives you the same, $13,847 rounded as your accrued depreciation. Don't forget to add the site value, and that formula is reproduction cost of the structure minus accrued depreciation equals the depreciated value of the structure. The depreciated value of the structure plus the site value indicated is the value of the subject property. And the income approach, the theory is knowledgeable purchaser would pay no more for a property than the present value of the expected future income generated from the property. You're going to convert the anticipated income a property generates into a present value. Gross rent multiplier analysis. That is the ratio between the property's gross monthly rental income and the sales price. It is appropriate when properties are purchased and sold on the basis of gross income. It is reliable for valuing rental houses and small multifamily properties that earn monthly income. Step 1. Develop a market area GRM, and the formula is the sales price divided by the gross monthly rent equals the gross rent multiplier. You're going to estimate the subject property's market rent and multiply the market rent by the GRM. So your formula is market rent times the GRM gives you your estimated market value. Gross income multiplier analysis is the ratio between the gross annual income and sales price. It's applicable for small income producing properties bought, sold, and appraised on the basis of annual gross income. The formula is sales price divided by gross annual income gives you the gross income multiplier. You're going to take the gross annual income and multiply it times the gross income multiplier to give you the estimated market value. The overall capitalization method measures a flow of income projected into the future. Market value is estimated based on the present worth of future income. It uses the relationship between value, income, and rate of return. Reconstructing an operating statement. More complex income-producing properties use net operating income to estimate value. Expenses included would be vacancy and collection loss, real estate taxes, hazard insurance, utilities, maintenance and repair, and management. Expenses not included in a reconstruction operating statement is business income tax payments, IRS allowable depreciation of improvements, interest on mortgages or business loans, and mortgage payments. Steps in the income capitalization approach. You take your potential gross income minus vacancy and collection losses plus other non-rental income, and that's going to equal your effective gross income. Then you subtract your operating expenses and you have your net operating income. Operating expenses are expenses that contribute to the operation of the property. There are three categories: fixed, variable, and reserves for replacements. Estimating a capitalization rate, the appraiser uses comparable properties: comparable net operating income, comparative market value, and the formula is net operating income divided by value is going to give you your capitalization rate. The average capitalization rate equals market-derived capitalization rate. The formula for estimating value using the income capitalization approach, you take your subject property net operating income and divide it by the market-derived capitalization rate, and that's going to equal your value. Here's an example. What is the value of a property with a net operating income of $60,000 if the market capitalization rate is 10%? $60,000 divided by 10% gives you a value of $600,000.